Hello, these are the examples for Chapter 8 in Principles of Accounting. We're talking about long-term assets in Chapter 8 and how we account for them over a period of time in order to meet the matching principle where we meet our expenses with our revenues. So the first example that we're going to look at is purchases of long-term assets. When we purchase items as a bundle, and then also what can we include in the purchase price that gets recorded in the account for the first time. So in this first example, we have a purchase of land. And then we also paid to tear down an old building, to prepare the land for a new building. We built a new building, and we put in lighting and a parking lot area. So if we're looking for a journal entry to record this, we need to record each of these long-term assets separately. Part of that is because land is not depreciated. So the land account needs to be on its own, separate from property, plant, and equipment accounts that do get depreciated. Secondly, because we would have different depreciations for different items. So we would have the building, the land, and the land improvements. So we need to debit each amount, and then we have a lump sum cash payment. So what our debit amount is for each of these items, we have that the building was $1,452,000, and that the land cost, let's get to the land last, but the land improvements for lighting and a parking area, $87,800. Now, into any asset purchase, we can include things that a reasonable person would believe we had to spend in order to make that asset usable. This includes things like sales taxes, legal fees, permitting fees, installation costs, and in the case of land, it's what we pay to get the land usable. So because we had to tear down a building and then fill and level the lot to get that land usable for our purposes, those are included in the historic cost of the land purchase. So our debit to the land account would be $390,000 plus $33,500 plus $47,000. And our credit to cash is the sum of all of our debits we pay in cash. This next purchase is a lump sum purchase, and we paid a lump sum of cash for real estate, and we need to separate that lump sum of cash out between land improvements, and the building account. So we have a very similar journal entry to the one we have here. The only difference is the amounts. So we have our cash amount, which is $395,380. In order to record what the amounts are in the other accounts, we have to look at the appraisal value of them. So we have the building, land, and land improvements. And for the building, it's appraised at $176,670. Our land is appraised at $157,040, and the land improvements are appraised at $58,890. So we would add all of the appraised values together. We then take the amount of each item divided by the total appraised value and get the percentage of the value. So now we can use these percentage to allocate our cash payment to the correct accounts. So the building is 45%. So we're going to take our cash amount times 45%. And we record that with all of the cash account times the percentage and our cash account times 15% for land improvements. So now we have the amounts for each one of our items based on their assessed value. Next, we're going to talk about depreciation, and we're going to look at the 3 different methods of depreciation that are discussed in Chapter 8. The first depreciation method is straight line depreciation. So we have a piece of equipment and we want to know what the second year depreciation is under each one of these methods. Straight line depreciation is the same every single year. So our depreciation is based on our historic cost minus salvage value divided by useful life. So for this product, we have a cost of $43,500 minus the salvage value of $5,000 and a useful life of 10 years. So every single year for 10 years, our depreciation expense is $3,850. The next method we're going to look at is units of production. Units of production is similar to straight line depreciation in that we start with historical cost minus salvage value. But instead of dividing by years of useful life, we divide by the units of useful life. Units of production is popular for vehicles. So say we have a truck fleet, and we might say that trucks have a useful life of 300,000 miles. Then that is our base for the units of production method. So we start with the cost of $43,500 minus the salvage value of $5,000, and then we divide it by these 385,000 units of production. And we end up with a rate of 10 cents per unit. For year 2 depreciation expense, it tells us that we used 32,500 units of production in year 2. So we would take 32,500 times our 10 cents per unit rate. So our depreciation expense in year 2 under the units of production method is $3,250. The double declining balance depreciation method is an accelerated depreciation method that doubles the rate of straight line depreciation. So we take our straight line rate So 100% of our depreciation divided by a useful life of 10 years gives us a straight line depreciation rate of 10%. We double that for the double declining balance rate. So 10% times 2 is 20%. The next thing for double declining is that we take the book value times 20% to get our depreciation rate for each or expense for each year. Book value is the cost of the machine minus any accumulated depreciation. So first we have to calculate our depreciation expense in year 1. So our year 1 depreciation is the cost of $43,500 times our rate of 20%. So our year 1 expense is $8,700. Now we can calculate year 2 depreciation. We take the historic cost, $43,500, minus our accumulated depreciation of $8,700, and take that amount times our 20% rate. So our second year depreciation under the double declining balance method is $6,960. Our next example is partial year depreciation. So we've been looking at full year depreciation in our other examples. However, unless we make every single purchase on January 1st, on December 31st, we can't take a full year depreciation. So in partial year depreciation, we take our amount times the amount of time that we've actually owned the asset. So if we're doing straight line depreciation, we know that our straight line depreciation formula is cost minus salvage value divided by useful life. So for year one, we need to figure year one and year two. Year one is our 280,000 minus the salvage value of 40,000 divided by our useful life of 5 years. And then that amount is taken times the amount of time in the year that we owned it. April 1st to December 31st is a 9-month period. So we take it times 9 divided by 12. So we get a year one depreciation expense of $41,400. In year two, we would take the full straight line depreciation amount. So 280,000 minus 40,000 divided by 5 years of useful life. So we would get the full year amount. For double declining, first we need our rate. So we have our straight line rate and our double declining balance rate. Our straight line rate is 100% divided by the useful life of 5 years. So our straight line rate is 20%. That makes our double declining rate 40%. So in year one, we would take the cost of 280,000 times 40%, and then take that amount times 9/12. And we get a rate of 84,000. In year two, we would take 280,000 minus our 84,000 rate, or accumulated depreciation, times our rate of 40%. And in year two, our depreciation is $78,400.